The crypto market lost more than $800 billion in value, one of the fastest wipeouts in its recent history. But it didn't start with a hack, or a new regulation, or even a scandal. It started with a headline, a sudden announcement, 100% tariffs on Chinese tech imports. Within hours, the shock spread through every risk market. Liquidity dried up. Billions in leveraged crypto positions were liquidated automatically. And as always, the panic moved faster than the data. Bitcoin fell. Ethereum followed. Altcoins collapsed like dominoes. And behind it all, the same pattern we've seen before. Whales moved early, insiders hedged before the news, and everyone else watched the floor vanish beneath them. But this wasn't just another crash, it was a correction that had to happen. Because for months, the system had been overheated. Too much leverage, too little value, and far too much belief that the good times could last forever. The crash didn't destroy crypto, it revealed it. And what comes next depends on who learned the lesson. It began the way every chain reaction begins, with one spark in the wrong place. When the tariff announcement hit, the markets were already nervous. Inflation was cooling, but liquidity was thin. Traders were over-leveraged, chasing quick wins instead of long-term plays. And as always, crypto, the most sensitive barometer of risk, became the first to crack. At first, it looked harmless, a small dip, a few red candles, some profit-taking, nothing unusual. Then the liquidations began. Billions in margin positions started to unwind automatically. Stop losses triggered across exchanges. Algorithms sold to cover losses, and human panic did the rest. Within hours, the market fell faster than any single headline could justify. Bitcoin dropped nearly 20%. Altcoins, 40%. Hundreds of billions vanished before most investors even knew what was happening. But beneath the chaos, the mechanism was simple. The system had been stretched too tight for too long. Too much borrowed money, too little patience, too many people believing the same trade would always win. The tariff didn't cause the crash. It just exposed how fragile the system already was. And once that truth hit the market, everything else was just gravity. The headlines always make it sound dramatic, as if one decision, one announcement, or one tweet could break an entire market. But crashes don't begin in a single moment. They build quietly, and then they happen all at once. When the first liquidations hit, the whales were already ahead of the curve. They'd moved liquidity into stable assets days before. They had exit plans, limit orders, hedges, ready. Most retail traders didn't. And that's how every correction becomes a collapse, not because the system breaks, but because the crowd reacts too late. As positions were forced sold, liquidity vanished from exchanges. Market makers widened their spreads. Volatility bots went wild. And for a few chaotic hours, the entire crypto ecosystem turned into a feedback loop of fear. Charts stopped being data. They became emotion. Every red candle triggered 1,000 more. Every dip, someone's liquidation point. By the time the dust settled, over $800 billion in crypto value had disappeared, not because it was stolen, but because it was never really there. It existed in leverage, in speculation, in belief. That's what crashes do. They don't just erase wealth, they erase illusions. When the noise finally stopped, what remained was silence and clarity. The projects built only on hype were the first to disappear. Tokens with no purpose, no users, no value, gone, almost overnight. Because crashes don't destroy innovation, they filter it. The truth is, the market wasn't healthy before this fall. It was bloated, swollen by cheap money, and held up by borrowed faith. The correction didn't break crypto, it cleaned it. And what's left now is smaller, but stronger. You can see it if you know where to look. On-chain activity still steady, developers still pushing updates, long-term holders barely moving. The noise collapsed, but the signal stayed. This is how every real cycle evolves. Hype builds the crowd, the crash removes it, and what remains is the foundation, quiet, stable, ready to grow again. So no, this wasn't the end of crypto. It was the end of the illusion. Every crash feels like an ending, but in truth, it's not the end. It's a reset, a forced return to reality. The market needed this. For months, prices were sprinting ahead of progress. The correction didn't erase the future. It simply brought it back in line with the present. Now, the noise is gone. Speculation has gone quiet, and what remains is opportunity. Because this is when the real work begins. When the builders keep building, when investors start thinking long-term again, when ideas stop chasing hype and start chasing impact. Look back at history. From the dot-com crash to the early Web3 surge, the story is always the same. The collapse clears the field for the ones who truly understand the game. The smart money isn't running away, it's repositioning, shifting from noise to structure, from speed to systems.